Despite so many people being of the opinion that property prices will crash, the data is clearly showing that prices are continuing to grind upwards. But some things have definitely changed. So today I want to do a deep dive into what's going on around our various property markets. I've got a number of charts and tables to go through so that you can see for yourself what's happening to property prices. And as I go through this episode, I'll also be addressing some of the headlines you're starting to see like this. So if that's what you want, stay tuned. Hi, it's Nero here, and let's begin by looking at the core logic data for last month. So let's begin by looking at Sydney, and last month property prices in Sydney grew by 0.9%. Okay, but that's half of what happened the previous month in June when property prices grew by 1.8%. So that's a staggering reduction. So does this mean then that property prices are going to crash now that the rate of growth has slowed? No, not at all. I'm really glad that the rate of growth is slowing, because at 1.8% growth per month, which is what we saw in Sydney in June and also in May, that's an astonishing 22% annualized growth, which means if we continued at 1.8%, that's how much property prices would grow in Sydney when interest rates are at the highest they've been at in over a decade. Well, then can you imagine, with all the migration happening and whenever interest rates start to drop, what would property prices do then? They'd be even more unaffordable, right? So I personally am really glad that the rate of growth is slowing, and I do expect it to slow even further going forwards, which is exactly what Core Logic Director Tim Lawless also has to say. In a recent article in the AFR, which talks about Sydney's house price growth has peaked, Core Logic Research Director Tim Lawless said Sydney's home values could slow further as listings rise. It looks like Sydney's growth rate has peaked in May, and I can't see any reason why the pace of growth would rebound, at least until interest rates start coming down, he said. So I wouldn't be surprised if the 0.9% monthly growth reduces further from here. It's still a fairly strong growth, right? And it is, because if you have an average monthly growth of 0.9% for a year, you still end up with over 10% growth in property prices for the year. So it's still strong, but it's not as strong as the 1.8% that I mentioned earlier on. Lawless then goes on to say, I think there's definitely some room for it to reduce further back to maybe 0.2 to 0.5% month on month, which is more sustainable and realistic. So what it shows you is the rate of growth in Sydney is expected to slow. I definitely agree with that, but property prices are still expected to finish the year off higher than they are right now. And you can see the evidence of that when you see headlines like this. Buyers step up as home auctions get busier. Robust demand from home buyers has kept pace with the rising number of properties being offered for sale, with the national clearance rate holding steady above 70% even as auction listings jumped. So that's the national auction clearance rate, not just Sydney or any of the other capital cities, which I'm about to come to in a moment. It's showing you that there is still very, very strong demand out there. While listings jumped 9.4% to 760 auctions in Sydney in the past week, the preliminary clearance was 72.4%, down only slightly from a week earlier. In Melbourne, listings bounced 24.4% higher, with 846 homes to go under the hammer. Nevertheless, the preliminary clearance rate improved from a week earlier to just shy of 70%. So generally, when you're starting to see auction clearance rates of 70%, that is a very strong indicator that property prices are set to keep rising. But then we're also seeing headlines like this. The house that gained $500,000 in just 9 months, again referring to a property in Sydney. Or this article here, which again talks about the Sydney market, saying that buyers are now starting to panic. The article then goes on to say that buyers are now starting to panic, and it looks like we're starting to see FOMO, or a fear of missing out again. So what it again reinforces that in the Sydney market, even though there has been an increase in listings, which is good, it's still nowhere near enough to meet the demand. And that's what's going to keep driving property prices higher, but thankfully at a slower rate than what we've seen so far in 2023. Now, if we go back to the CoreLogic data and we now look at Melbourne, we know that last month, Melbourne property prices increased 0.3%, which was again a marked reduction from the 0.7% we saw in the previous month. So certainly our two biggest markets are slowing down in terms of how much they're growing. But now have a look at some of these markets. Brisbane last month grew 1.4%, which is in line with what it grew last month at 1.4%. And if that continues, that would be an annualized rate of growth of 16.8% on average for Brisbane, which is, again, boom time conditions, right? Adelaide property prices grew 1.4%, which was much higher than the 0.9% the previous month. And Perth in July grew at 1%, which was similar to the 0.9% of the previous month. So what does that tell you? It tells you that capital growth is slowing in our bigger capital cities on average, but it's actually accelerating in a lot of our smaller capital cities, right? And that makes a lot of sense, especially when you consider this chart. This chart tracks capital city dwelling price growth. The data is from CoreLogic and Macro Business. And what I want you to do is look at the red line, which represents Sydney's property prices. And what you can see is that Sydney property prices are the most volatile when it comes to capital growth. Sydney is the market that first started to fall in value when the RBA started increasing rates, and Sydney was the first market that then started to increase in price this year. And if you understand that, then it really gives you an opportunity to take advantage of different markets out there, because when you see Sydney prices start to rise, and if you can afford to buy in Sydney, fantastic. But if you either don't have the budget to buy a house in Sydney, or you don't want to spend nearly $2 million for a house, then you can look at other smaller markets, other smaller capital cities, or even regional markets that are now going to keep growing at probably a faster rate than Sydney, because that's just what happens with our property markets. And this chart here from CoreLogic really shows how there's a change of guard in terms of which markets are leading the current property price rebound. So you can see here on this chart, when it looks at what's happened last month, Sydney prices, which is a dark blue line, rose. Regional New South Wales, which is a purple line, which is missing, essentially meaning that regional New South Wales prices didn't change on average last month. But then look at Victoria. Melbourne is the weakest capital city in terms of price growth. The only two cities worse than Melbourne are Canberra and Hobart, right? So Melbourne is struggling. Regional Victoria, property prices are continuing to fall, okay? But then look at Queensland. Brisbane, the dark blue line there, growing strongly. Regional Queensland also growing strongly. South Australia, Adelaide growing strongly. Regional South Australia also growing strongly. But in Western Australia, what you can see is, yes, Perth is growing, but on average, regional Western Australia is not doing so well, okay? So even though the median Australian property price is rising, it's not rising everywhere. So you need to do your due diligence. You need to be able to choose the right markets and then choose the right suburbs. Suburb selection is going to be critical for you if you want to take advantage of this next property boom. So yes, property prices are rising, but then you start to see headlines like this, which says, more investors bail out as mortgage costs rise. The portion of investor-owned listings across Sydney ballooned to a record 39.8% last month as the financial stress of meeting the large increase in mortgage repayments worsened, data from CoreLogic shows. More investors were also selling in Melbourne, Brisbane, Perth and Darwin, while Adelaide and Canberra posted a slight dip. So you see headlines like this, and it can really stoke that fear of, is now finally when the property market is going to crash. That's why I went through the data to show you that property prices are actually rising in most of our markets. They're rising much stronger in some markets than others. And that's why you don't want to be swayed by these sort of headlines. They can easily lead you to making a mistake by missing out on some of the great opportunities that are out there. But if you do choose to invest, make sure you do your due diligence. As I said earlier on, Suburb selection is critical, and if you want help to find out where are the best places for you to invest, then check out the link in the description where you can get totally for free the digital version and audio version of my book. Plus, if you want to find out more about our buyer's agency service, you can there as well. Either way, I'll see you next time.